Hi, this is the coveted post-lunch afternoon slot, but this is also the outlook for 2019, and I'm sure anyone who's been following markets has quite a few questions about what 2019 is going to look like and how they might be able to navigate it as investors. So hopefully we're going to help you out on this panel, get some great perspectives on what might be happening next year and how you can potentially even make some money off of it. I say that flippantly, but one statistic that really jumps out at me about 2018 is that 90% of asset classes posted negative returns in terms of US dollars in 2019. That was a complete reversal of, in 2018, a complete reversal of what happened in 2017, where nearly every asset class posted positive returns. So this is the kind of environment we are dealing with. I'd like to quickly introduce my panelists. We have Kinji Kato. He is the Asia CEO of Natixis Asset Management in Japan. We also have Kathy Matsui, the Goldman Vice Chair for Japan, and we also have Virginie Maisonneuve, the CIO of Eastspring Investments. So just to begin, why don't we start with the volatility that we've seen in markets? The S&P 500 up 1% on Monday, then down 3% on Tuesday. What's going on? How do we account for this volatility? Virginie, let's start with you.
Yeah, I think what I call that the yo-yo environment, right? Clearly markets don't like surprises, and we've had a lot of surprises with a lot of political volatility. And you know, the way I summarize it is ground control to Major Trump. Can we have a little bit more, stability? Beyond this, though, I think you can use volatility. So, you can position yourself in low vol strategies to help diversify your offering or structure your products. And also, if you have your roadmap over the medium term, take advantage of those pockets of weaknesses to accumulate positions that you like. So, one of my key themes has been artificial intelligence for a long time now. And I think, when you see tech stocks, particularly if they're well positioned, do very badly, then you want to add back to them. Similarly, if you're building your ESG kind of franchise and you see companies doing very badly in that thing, you use that to accumulate positions, but you have to be quite diversified to withstand the volatility.
Right. Kathy, we were discussing this earlier, but how much does quantitative tightening play into the current environment?
So obviously, if we take a look back at how global markets have performed, especially in the stock market arena, we've experienced and enjoyed an extraordinarily long cycle of positive returns, obviously this year being very different. But what's driven that has been a combination of what I call these very wide jaws. On the one hand, very high above trend growth on the one hand, and on the other hand, extraordinarily low interest rates, or QE, quantitative easing. And that has created this, what you want to call it, Goldilocks type environment, which has made markets very euphoric and very jubilant. So when those jaws, so to speak, of higher than average growth and excessively low interest rates starts to close, i.e. the growth and inflation mix becomes worse or deteriorates, then obviously investors naturally are worried about, okay, when's the shoe going to drop? When's the party going to be over? So I think any kind of hints of whether it's Brexit or it's trade friction or it's geopolitical issue, everybody's looking for a reason to sell, or this is, the signal that it's all going to end in tears. So I think investors are very nervous, on edge for what's going to come, tomorrow.
Right, and we certainly saw that this morning with the U.S. equity futures.
Yep.
Kinji, on that note, do you buy into the quantitative tightening argument as well? Do you think the withdrawal of global liquidity is necessarily going to impact risk assets?
Okay, so that's not my specialty, but I'd like to make a comment on the market volatility. Okay, just as both of them mentioned, there are so many things unclear. It's impossible to predict what's going to happen. Brexit, trade, this is just like a flip the coin. So that's create a big volatility and to give some investor a reason to move to cash and buy. And we call that Mr. Market, up and down every day. Yeah. So that's essentially the U.S. economy is still solid and strong, and we don't see any recessions. And those are the basic is sound. So we still see the good opportunity because of the volatility.
Right.
Okay. For example, in U.S. corporate bond, now it's triple B is now over 50% on new issuance. So the passive investor is taking more risk. So by definition, that's why in this volatile market, active bottom-up is very important.
Right, and we certainly have seen some concerns over cracks in U.S. credit recently. There's a great chart right there showing issuance in the investment grade market. Kathy, just on the QT note, what's your base case at the moment for when the BOJ might actually start to taper its QE program? Because, of course, the BOJ, really the original quantitative easer, and we have seen an enormous impact in the Japanese market from those actions.
So that's a question we get asked every single day by our clients. And for what it's worth, our house view is the following, that as long as the Bank of Japan is sticking to its 2% inflation, this is not nominal CPI, this is core inflation, ex-food, ex-energy measurement, which is a lot lower than the headline. Unless they abandon that target, it's very hard for them to rationalize why they would make a meaningful shift. And I emphasize meaningful because it doesn't exclude or preclude the possibility that they make further tweaks to the current framework. For example, remember in July, and they came out with, well, we can, let's widen the band around the 10 years. So the yield curve control targeting was made a little bit more flexible at the margin, but it was still negative interest rates. It was still keeping ultra-loose monetary framework in place. And I think the issue is not only that, but face it, next October, if everything goes to plan, the government still wants to proceed with the consumption tax hike from 8 to 10%. Any way you slice it, this is fiscal tightening. So does the Japanese government, by the way, one other very big event is July next year is the upper house elections, super critical for Prime Minister Abe, right? So do you really want to go into 2019 with fiscal tightening on the one hand and simultaneously tightening on the monetary front? That mix is not really a healthy one if you want to keep your economy afloat, given all the global uncertainties around the world. So our view is, again, anything can happen, but our base case scenario is that the BOJ most likely will stay put until at least after the effects of the VAT hike are seen, and they can monitor that, and then perhaps they will proceed from there. Now, of course, the counter argument is, well, you're giving yourself zero cushion for maneuver in the event that the world does enter a recession in the next 12, 18 months. What is the BOJ going to do? They have no room for maneuver. That is true, but the government's response to that is they do still have fiscal stimulus in their pocket. So if they need to, they can issue more debt. And why not issue debt when rates are zero as opposed to when rates are higher? So that's our rationale.
Right. Now, you mentioned the magic word, which is recession, which everyone seems to be worried about. Lots of people coalescing around 2020 for the start of a potential U.S. recession. Let's get the audience involved. We have an interactive poll that you can participate in. The question is, where are we in the cycle? And I should specify it should be, where are we in the U.S. economic cycle? Does everyone have their app that they're able to access? All right, so you have a few options. At the beginning, somewhere in the middle, it's late, but we still have more room to run, or we're nearing the end, everyone panic. I'll give you a few minutes. Oh. I'm surprised people aren't rushing out of the room screaming. All right. All right, it looks like we're coalescing around. We are somewhere close to the end, but still a little bit more room to run. I'd like to hear from all the panelists on this topic. The U.S. economic cycle, clearly of importance for the entire world economy and Japan, of course. Virginie, let's start with you. Where are we?
Well, I mean, I actually agree with this forecast, which is what worries me. But I think My view is 2019 is a resynchronization of global growth to the slow side. So the US is slowing down from 3+ to 2.5, and the world, is slowing down, but not in a recession. I know the bond market is sort of eager to flag that recession, but actually you have seen a situation in 88, 98, and 2005 where you had, the curve in a shape that would indicate recession, yet it took 18 months or longer, and we had a very strong equity market in the meantime. So I think you can't compare it really to what we've seen in the past because of QE, because of the extraordinary. So what you have to do really is focus again on the pockets of opportunities, identify them and buy them for the long term. So my view is we will have peak US interest rates over the next 12 to 18 months. We think 3 max. That will have an impact on the dollar. However, going back to the yen, that's the one where I'm the least comfortable, because clearly it's dollar versus something. Depending on the activity in Japan, that might. But if you have a peaking dollar versus most currencies, then everybody's underweight emerging markets. If you have at the same time China putting monetary policy as a result of the fear around trade, et cetera, we know emerging markets are actually much higher correlated to monetary policy in China than to the US. So you could be in a position that takes people by surprise. That would be my base case scenario, not a recession.
Kinji, let's bring you in because you were talking about corporate credit, U.S. corporate credit. It's what we used to call the smart money in the room. What is the smart money telling us about where we are in the U.S. economic cycle?
Okay, so I agree with everybody, the late expansion, but at this time expansion is very long. Okay, sometimes clock goes back and forth. So we don't see any near-time soon recession. But we have seen some changes, just like we saw the chart, corporate bond issuance and BBB issuance. But it's because of the Mr. Market volatility we saw this year's. Corporate bond spread already widened. For example, high yield in the past 2 months widened already 100 basis points. And BBB issuance now most in IG market is 40 basis points. That is like getting close to the average for the past 5 years. And the default rate we expect continue to be low, like 2 or 2.5% next year in the following year. So right now we are getting enough premium for the credit. But we need to be careful for the total credit IG is getting lower. So, bottom-up driven investment is much more important.
Right. Kathy, I'm going to modify the question slightly for you, for your monetary policy expertise. The Fed tightening, a Fed tightening cycle, does that necessarily have to end with a financial event of some sort? By which I mean market volatility, something like that.
No. I think if you look back in history, there are, of course, occasions where that is true, where there is some sort of exogenous or some kind of financial shock that causes monetary policy to tighten for the Fed. But I think more traditionally or conventionally, it is because inflation, which they are targeting, becomes out of control or excessive. And so if you look at the United States right now, or just look at most cycles in American economic history, what causes a recession? It's usually either excessive inflation on the one hand or some kind of financial/credit private sector imbalances, right? And I think that latter may be more associated with some kind of shock, in the system. If you ask me, my personal view is of those two risks, I think it's actually the former. And that is actually why Goldman Sachs has a fairly hawkish view on the Fed. We actually have not 1, not 2, not 3, not 4, but 5 hikes from now until the end of the year, which none of our clients believe, by the way, but it is what it is. I realize the tone of the Fed has become more dovish in recent weeks, et cetera. But anyway, our position is this, that we think the street is far underestimating the extent to which American, the jobs market, which remember full employment should be unemployment about 4.5%. We expect unemployment to drop to 3%. 3% from 4.5%, that's huge, massive undershoot, which builds the ground for much more wage inflation, which will push up PCE inflation. And in the end, the Federal Reserve as a central bank has two choices, don't they? On the one hand, they could sort of proactively, preemptively tighten policy to ensure that inflation doesn't go out of control, or they can just sit back and wait and then let it rip, and then they've got to pull hard. So I think our view is more the former, that's what they will be, more focused on. So, and it's not exactly answer your question, but to be, explain the view that we have, we think that it doesn't necessarily have to be a financial event. And as far as we can tell, yes, there's some widening of credit spreads in the credit market, but if you look in the aggregate at corporates pretty much in the developed world, most companies around the developed markets are flush with cash still, on balance, right? Mm-hmm. There is some leverage buildup, absolutely, but it's from very, very low levels. And even if we're talking about rates at 3.5, that's still very low in a historical context. Mm-hmm. So we're not so worried about private sector imbalances, but I think the inflation piece, we really need to monitor much more carefully than I think the vast majority of market participants currently are.
Right, so it's definitely an outlier position, but you might be vindicated tomorrow because we have the U.S. jobs
We
number.
Shall see.
We shall see indeed. All right, we already heard a number of risks on the horizon for 2019. Kathy, you mentioned the consumption tax hike. Virginie, I think you mentioned, was it Brexit, or have we got there yet? No, we haven't. All right, I can name more. The Fed tightening, obviously, and the ongoing trade tensions between the U.S. and China. I'm wondering if everyone could choose the thing that they are most worried about and how worried they actually are. Virginie, let's start with you.
So I think I think clearly there are a number of risks, right? That's why markets are volatile. One is how do you price political volatility, to this yo-yo strategy, to Brexit, Spain, Italy, all of this is part of it, right? I think, though, if I think of 2019 again, I think what Kathy just talked about is the key to the puzzle. I tend to believe that, yes, employment, is very important. But if you look at what's happened since we've had the recovery, the wage inflation is much lower than what you might have seen otherwise, because, again, it's that theme of artificial intelligence and robotization and all of that. I think that theme is going to accelerate. But if you are right and inflation accelerates much more, then that is the big risk in the system, in my view. Brexit, Italy, that's very hard to forecast. I'm just trying to step back. For Brexit, what are the alternatives? Mm-hmm. And the reality is, it seems to me that the alternatives are worse than what is presented right now. So, clearly we'll know very soon, but I'm certainly hoping that we go towards something quite rational. Italy could be a little bit more tricky. But, I think once we'll know about those quite soon. Of course, the inflation one is the one that's lingering, and that's going to be there for the longer term, right? So the other one would be feeding into inflation is oil. Mm-hmm. Which is, of course, very important. But if you think you have a global slowing down economy, you continue to have renewable costs coming down, and you continue to have climate change as the central issue, in my view, right? Continue to be. I just, except if you had a major shock, I just can't see the oil price roaring up from here. Mm-hmm. So I'm not so worried about that. It's probability weighted. So I would go back to what Kathy said. I think that's the key to this risk question.
Kinji, I'd love to hear from you. There's a wall of worry facing investors. You must choose one brick that worries you the most.
Okay, so I'm not worried about something, we can have a good expectation, just like, Brexit, who knows what happens, Italy, who knows. But it's difficult to guess what's going to happen for the trade dispute. But I think, Trump is smart enough, try to avoid getting into U.S. economy recession. So then I think, Fed does not have good track record to take care of these changes, and often something at the end collapse. So that's, and now it's a very difficult situation for their policy. So that would create, liquidity crunch and so forth. But on the other hand, economy and corporate earning is quite good. And as I said, they have enough cash on the balance sheet and so forth. Not such credit crunch, but maybe equity market and so other big, market crash due to bad track record of Fed.
Okay, well, nothing to worry about then, just a big market crash. That's great. Okay, well, speaking of this, let's bring out our second polling question. Here's a game, and I need to put a disclaimer on this before I ask the question. We are not actually doing this, but in theory, Bloomberg gives you $100,000 to invest at the start of 2019. Again, no one here is actually getting money from Bloomberg. Where do you put it? 10-year treasuries, gold, developed market equities, which is going to include Japan, EM equities, U.S. corporate credit. If we'd been doing this panel last year, I would have added Bitcoin as an option.
What's your time horizon, 12 months?
For 2019, sorry, that's
the whole year, 12 months.
Yes, you are thinking like a CIO, aren't you? This is for a 12-month horizon. Gold, wow. Who is choosing corporate credit? No, you don't want to admit it. Okay. All right. Well, clearly a risk-averse bunch. So again, I'm going to ask the same question to our panelists. But when you look across the horizon for 2019, I realize 12 months is a pretty short horizon for an investment return, particularly a dollar-denominated one. But where do you see the most value? Kathy, why don't we start with you?
Well, it's not on this chart, but I would put it in women's education, but that's a separate topic altogether. But if I'm limited to these challenging options, I would actually say I think the opportunity, at least if you look at our house views on regional or asset classes generally around the world, we're still overweight equities, not by a lot. Because of the growth inflation mix deteriorating, because valuations are no longer cheap. But if you look at these options, we don't have really gold in our asset allocation, but we still think equities have the best return potential. And within that, we still actually like parts of emerging markets in Asia. And to the point that, Virginie, you mentioned earlier about the dollar, we actually have shifted our house view on the dollar. We actually think there's dollar weakness coming ahead, even despite what I just described to you about our Fed call, which looks very inconsistent. But we think there are going to be more concerns about the health of the U.S. fiscal position. And the kind of the tail end, we're heading towards the tail end of the Fed tightening cycle. We think there is going to be more pressure downward on the U.S. dollar, which should act as a little bit of a tailwind. Coupled with, if you look at a market like China, our colleagues in China or looking at China are of the view that yes, the news flow right now is terrible, but it's been actually pretty terrible for quite some time now, and that is not lost on any Chinese policymakers. So they are throwing maybe not the kitchen sink, but a lot of fiscal stimulus, a lot of credit extension, et cetera, to try to stabilize the growth picture in China. And we actually think they will be probably more successful than not. So we are bullish on Chinese equities, some Southeast Asian markets, And so I'd say, we like Japan too. It's kind of close between Japan and emerging markets, but developed markets includes other markets besides Japan. So I'd say between Japan and emerging markets in Asia would be our top picks.
So we actually only have a few minutes left, and I want to get to a topic that, Kathy, you just alluded to. This is not an option that was on your chart, but there is such a thing as ESG investing, which is environment, social, and governance investing. A lot of the sell side are certainly pushing this at the moment. What sort of potential do we see there, Kinji?
Okay, so our group, we are the first group to create a dedicated ESG firm we call Mirobai. And as of French asset management company, has been serious for the past 20 years. And also for the corporate bond, sustainability is the key for the corporate bond research. That's why even in this market, if we focus on this ESG type of analysis and incorporate into our traditional research base, we see the good opportunity to deliver the good performance on each sector. Not only equity, but also corporate bond. Even we have alternative private debt. Company newly acquired from 2002, focus on even private debt for the ESG.
So, Virginie, from the buy side, I have a question, which is obviously ESG gets thrown around a lot, but how do you make sure that you're buying something that is actually as labeled and it's not just a marketing gimmick?
Absolutely. So I have personally been an ESG investor for over 30 years, even before it was called ESG. We just signed at Eastspring the UNPRI back a few months. And it has to come from the bottom up. So I think what you do is you really need to set up the vision, make sure people have the resources, but also embed that from the bottom up. So asking the right question, helping people understand what climate change governance, or giving information, making sure the process in terms of voting and everything is documented. In my view, you have today 21 trillion of assets in ESG or, in sustainable investing versus basically 30 years ago, and it will grow dramatically for several reasons. One, millennials want impact. Second, climate change, which is an issue again that I've looked at for a very long time, is going to increase dramatically, and there's going to be much more public, if you want, awareness about it. So our clients are going to demand it, and so yes, it's not optional in my view. You have to do it.
Kathy, we can't talk about ESG without also talking about Womenomics, which you have often been credited with at least coining the term and also pushing this as a big reform effort in Japan. How do you think that's actually going?
So I think it is making some progress. As we heard in previous sessions, though, it is a work in progress. There's still plenty of work ahead, but I think at the minimum, what I'm very, proud of, or I'm just very nice to see the fact that we're not talking about this diversity and inclusion, Womenomics, in kind of peripheral conversations about human rights and CSR, but it's actually become a central component of discussions about how to grow the economy, how to grow profits, how to boost revenues, how to boost clients' market share. So I think it's become out of the realm of human rights / CSR, that realm, into firmly diversity and inclusion. Womenomics is an absolute business and economic imperative. Now, still, again, a long way to go. We still have very few women in leadership positions, board directors, et cetera, that was mentioned earlier. But at least we're talking about the issue now, whereas before I don't think it was even a topic of conversation. So greater focus hopefully will drive improved behavior down the road.
All right, so hopefully we ended on a slightly optimistic note after talking about all the scary risks on the horizon. I'd like to thank the panelists. The summation for the 2019 outlook: buy green bonds and gold, according to the audience, I guess. All right, thank you so much for being here.
Thank you.